Hi, let's do some more revision and try to do it in less than 15 minutes. Today we're going to look at the appropriation of net profits for partnerships. So if you recall, when we did the sole trader kept all of the profits for him or herself, so they didn't have to share anything. However, in a partnership, you're going to have to share the profits. So obviously we're going to have to find a way to do it. So there are two new accounts that will pop up when you get to a partnership. The first one is the one we're going to deal with today, and that is the appropriation account, which would be used to help us to distribute the profit earned by the business amongst the partners. And then the other one would be in the partners' current accounts, which will just show how they benefited from their time in the business. So let's start with the appropriation account. Well, it's like, but we know in accounts, everything is double entry. So the appropriation account will be the double entry to the current account. So it basically shows how the partners agreed on the distribution of the business's profits or losses. And this account will be prepared, therefore, right after you've reached the net profit on your income statement. So therefore, we could call this, we could write it separately and call it the appropriation of net profits account, or you could just do it as a conclusion on the income statement. But of course, you'll have to adjust the name of the statement. All right, so what is really involved in this appropriation account? So it has 6 steps. So let's look at these 6 steps. So the first step will be to transfer the net profits from the income statement into your appropriation of net profit account. And then secondly, you are going to enter the interest on drawings payable to each partner, because the partners would have agreed that if anybody took out any money, they should pay some interest on that. Now, they don't always sort of expect to see it each time. Step number 3 says, well, we're going to add the interest on drawings onto the net profits to find out the total profits available. So once you know the total profits available now to be distributed, as it were, we will start to allocate, right? So step number 4 says that you're going to calculate the interest on capital that the partners would have agreed on, because you know the interest on capital is what the partners are going to benefit from having put the money into this business as opposed to putting it somewhere else. So they're going to get that interest on capital. And if there are any salaries being paid, like the partners who actually operated the business, those general partners, then you would also enter those salaries. If there are any bonuses that were agreed on, you make more profits than you make above a certain amount of profits, and you agree that this is what partners would get, some percentage of it, then that's the bonus. So once you entered all those different things in there, you're going to add them together. And step 5 says you will simply determine how much profits are to be shared by subtracting the total of step 4 from obviously the total at step 3. And that will tell you how much profit is left now to be shared directly amongst the partners, right? So once you've found that figure, then step 6 says to distribute that balance that remains in the ratio that the partners agreed on. And that is basically how you do the appropriation account. All right, so let's test our memories and see how it goes and see how you set it up. As usual, I'm going to use this vertical approach. You could write it in a horizontal way if you wish, or you could just keep writing over the partner's name under each line. It's up to you. But for a minimalist and efficiency, I just put the partner's name at the top and just go. All right, so the first step then says transfer the net profits from the income statement. So let's do that. All right, so we've transferred the net profits from the income statement. Second step says register the interest on drawings. So we take our calculators and we calculate the percentage of interest, the amount of interest that they're supposed to pay for the money that they took off the business, and we record it under each person's name and put the total over at the end. All right, so there we go. Interest on drawings for partner A, interest on drawings for partner B, and we add the two things together and put the answer over there. Then step number 3 says, we'll add those two steps together. So add the net profit plus the interest on drawings together to get the total profits available. So I have the total profits available here. And then now I go to step 4. So step 4 says, okay, we want to find out what we got to take out of these profits before we start to share anything directly to the partners. Now, the partners are going to earn something. For example, the partners are going to earn the interest on capital because, remember, there's like the opportunity cost, right, which is what they gave up to put their money in this business in the first place. So we calculate that interest on capital. All right, so interest on capital A, interest on capital B. And then one or two of the partners, depending on the partners in the business, may have been the ones running the business and earning all the money, etc. So obviously, these persons should be earning a salary for working in the business, right? For working, not saying not watching the business, but actually working, doing work, right? So they'll get a salary of some sort. So in this case, we're giving both persons a salary, but in most times, the examiner might just give one person with a salary, so just look out for it. All right, so we got their salaries. And then there might be a case where the partners may agree, well, if you make over a certain amount of money, we're going to take a bonus of X percentage. So if that's the case, right, if there's a bonus, then we will put it in. So, if you get a bonus, you take it out. So all that money will be removed from the profits before the direct distribution. All right, as agreed in the thing. So what you do, you add up all those deductibles. So I got 3 things there. So we add up all 3 for each person and put the total over in line with the total profits available. So step 5 says, no, we need the balance. So all we need to do is to subtract, right? Subtract the net total of the deductibles from the net total of the profits available, and we should get the balance to be shared. All right, and that balance to be shared is now what we will share in the agreed ratio as determined on the partnership deed. And that, my friends, is all you need to do for a partnership appropriation account. All right, so I will see you next time around when we look at the current account.